now that I have power. I want to abuse it. Yeah, I guess so, if you are. Okay, cool. Hi, everyone. It's great to see you. It's great to see actual faces instead of looking at your awkward backgrounds in your house. I do hope to not wave at the end of this presentation, but I'm very likely to, and we're all going to just let it pass, if that's okay with you. Cool. Hi, I'm Cokie. It's really great to be here. I'm the founder of Twali, an on-chain professional services firm, and I'm a co-founder of Lasagna Tech, which is a banking-as-a-service micro-consultancy. Prior to these, I've worked all over fintech and crypto between here and the UK. I was chief of staff at The Block, had a BD for 11FS, worked at BCG, led their global fintech research practice, and prior to that, got my start in capital markets, so kind of been around the block, as it were. Just want to do a shameless plug for the companies I'm an advisor and or investor in. That's Ijara, Fintech Today, Atomo, and Daylight. If you have questions about any of them, please find me after. I love talking about them. Just as a quick thing I'm asking for, can we just have a symbol if I'm talking too fast? Like, can we just give me one of these if I'm going too quickly? I have a bad habit. All right, so I'd really like to thank Moov for having me here. Graham said I could talk to you about my hair routine, so let's get started on that. I'm kidding. Today we're going to talk about what you're not getting with as-a-service vendors. We're going to cover acquiring, issuing, the existing BaaS models, and I'll give you a tiny little glimpse into the future. I'd like to make a couple of distinctions up front just to structure this talk a little better. So this is what a bank looks like. When I refer to components in the stack, this is what I mean. I mean one of these guys. Oh, and I'm going to abuse this laser pointer. I'm so sorry. An easy way to think about this is think about internal teams at a bank. This I just wanted to get out of the way because we're going to come back to it. So hope that's helpful. All right. For the purposes of this conversation, as-a-service vendors can refer to any of the following. The first is third-party vendors. Third-party vendors are those who take one small piece of that stack I just showed you and deliver it via API. For example, Alloy began with a mission to turn repeatable work of identity decisioning into code, so they are an as-a-service vendor. Next one is the banking-as-a-service platforms. The contemporary banking-as-a-service platforms that bundle services of third-party vendors and integrate directly with the bank so that customers can focus on what they really care about, which is serving their customers. These companies are distinct from the bank, and they act as a platform on top of it. I don't think I have to over-explain that. We know where we are. There's definitely an example of one of these, but I just can't think of it. Oh, that's right, it's Moov. So that's what they do. Third one, controversial opinion right off the bat. Banks kind of count. So banks are somewhat becoming as-a-service vendors in the way that the platforms I just mentioned, the aforementioned banking-as-a-service platforms are. Hear me out. As banks mature and form tech-first teams that are focused on building platforms similar to the banking-as-a-service providers, we're getting closer to a world where banks can actually offer comparable speed to market. Don't get ahead of yourself. We're definitely not there yet, but for the sake of argument, we're going to include them today. So, are we all caught up? I will be stopping for questions like 1,000 times, so feel free to just softball those in whenever you want. Okay, so this talk is about what we're not getting, because it seems like we're getting quite a lot, and that is a lot of stuff all at once, but we're going to talk about what we're not getting. So I'm sorry if this all comes off as really cynical. I tried to make it kind of nice. Nothing I can do. All right, so I want to preface this with the following. As a completely independent third party, I can say this without fear of consequences. Nobody is allowed to be mad at me, but this is the truth. Every single one of these aforementioned parties is lying to you. No, under no circumstances will you be spun up in 3 weeks. No, your API integration is not 5 lines of code, and no, you will absolutely not be live by next quarter. So, bear that in mind, because we're going to deal with a rule of thumb. Good rule of thumb. Whatever amount of time your partners give you, add 3. If they say 6 weeks, they mean 9 weeks. If they say 3 months, they mean 6 months. This should help you grant grace to your partners that you choose to work with and anticipate any looming frustration or resentment. Plus, if they beat the timeline that you got from adding 3, then suddenly you're on fire, and you'll be very happy. Okay, moving on. Okay, first thing we're going to talk about, thank you, Phoenix, for making this, because I've never had to make this slide again since you did. Big shout out. Broadly speaking, there are 2 sides to every card transaction a customer makes. Issuing happens on the customer side, so that's us, and acquiring happens on the other side, which is the side of the merchant. In the middle is the little thing we call the card networks, which is Visa, MasterCard, Amex, and they run the rails to communicate between the 2 sides. Get it? Okay, cool. When a transaction occurs, each party in the stack talks to the parties above and below to decide whether to accept the payment, and in the case that they do, the money moves. For example, I, Cokie, swipe my card at Sephora again. My payment goes from the merchant acquirer to the card network to the issuer processor who approves or denies the transaction. Then the issuing bank, which would be my bank, pays the acquiring bank, which would be Sephora's bank, who pays Sephora. All because I, Cokie, needed Fenty Beauty. Now that seems like quite a lot of hullabaloo to me, but that's what we're doing. That's the way things work. So let's slow down and talk about both sides and what's going on there. So the card issuing side is really interesting, right? So on the issuing side, there are 2 main parties to be aware of. That's issuing banks and issuing processors. Issuing banks are banks that issue cards on behalf of the card networks, and the issuing banks kind of have special privileges from MasterCard, Visa, Amex, whatever, to issue their cards. Issuer processors work with the card network and issuing bank to approve transactions in real time at point of sale. They don't issue cards themselves. They partner with issuing banks who do. So that's a bunch of layers all on top of each other. Legacy issuer processor companies like TSYS work with big banks who are both issuing banks and own the customer relationship, which means that the bank has all the power. Newer players work with sponsor banks, issuing banks that provide the bank identification number or BIN required but don't own the customer relationship. For example, Daylight Bank sits on Marqeta, who sits on Sutton Bank, MetaBank, or Coastal, but in that case it's MetaBank. For neobank customers like Daylight or First Boulevard, this structure really, really works. But the layers aren't quite there yet, and let's take a look at the acquiring side to see what the other side kind of looks like. So, on the bottom layer of the acquiring side, you have the acquiring bank that's actually working together with the acquiring processor. Acquiring banks receive information from the issuing side about the transactions and cardholder account details. They also receive funds from issuing banks after transaction has occurred to make them available to the merchant. On the acquiring side, processors work directly with the bank. Payment processors manage quite a lot of the heavy lifting associated with processing payments. They primarily process transactions, but have also been empowered by banks to underwrite merchants, manage disputes, and make payouts to the merchants. So they're doing all the work there. There they are. On top, we have the payment service providers, or we kind of used to. Now we have something called payment facilitators, which is a little bit different and kind of rad. So in the last decade, most innovation in the payments field has occurred on the acquiring side. So again, that's these guys up here. So in the past, when I, Cokie, swiped my card at Sephora, the payment processor approved or denied the transaction, then facilitated money moving from the issuing side through the card network to the acquiring bank, which then sent money to the merchant. Fortunately, giants like Stripe have improved this process tenfold by adding a layer to the stack called payments facilitators. They either sit on top of the payment processors or replace them completely and work directly with the acquiring bank. They have a nice little blurb on their like guides on what a payment facilitator is, so I'll pull that up now. Cool. So today, many platforms and marketplaces help merchants accept payments by providing online services for companies of all sizes. Payments functionality has become integral for these platforms to differentiate their product and create stickiness, and merchants using the platform no longer need to establish that direct relationship with acquiring banks or payment gateways. So as you can see, the acquiring side is actually really accessible. There's a lot here that needs to happen on the issuing side, which we're about to get into, but in the meantime, I will pause. Do we have questions? Thank you so much for asking. The question was, where did I get my outfit from? This is from Theory, and it looks fantastic on me, and I wore this just for you. And I'm wearing heels because I didn't know how tall this would be. So thank you so much, Syra. It's been such a pleasure to work with you. Okay. Cool. So we haven't really questioned the issuing side of things, and there's a couple of reasons why, but mostly it's like, it's clean and it works. And right now these relationships look one of three ways. So as you can see here, the charter holder, which is the bank, they're the ones with the license that allow you to do anything, partners directly with the brand. So this is a more traditional way this could look. The easiest way, I think, to think about this is co-branded credit cards. I mean, this is not how things are done anymore. We're about to fix that in a second. But for decades, brands have partnered directly with banks just to get the obligation off them. Essentially, American Airlines here is offloading all the responsibility and pretty much most of the upside just so they don't have to deal with it, and it's all in the name of brand loyalty. And it's worth it for them because they're a corporation worth so much money that it doesn't matter, really. But I find this really easy to conceptualize, and hopefully it will help you set up for what things look like today. So, cool. So if this is the easy way, hi, Syra, this is the hard way. Okay, so now things look a little bit different, and that's to say that fintech brands have started partnering directly with banks to get more compelling economics. But this is painful. Yeah. The brand, in this case, H.M. Bradley, integrates directly into a bank, in this case, Hatch. And this works great for both parties because H.M. Bradley gets more compelling economics and they own that relationship, meaning that they're not feeding a bunch of mouths along the way. PSA, do not attempt this unless you have raised a metric butt ton of money and you have a ton of runway. This is a pain in the ass. But it does seem like the best option from an economics perspective. Fewer mouths to feed, direct access to the bank, here's what you're paying for. Number one, integration. Pricing for integration right now is like asinine. Nobody really knows how to price this, so don't be surprised if you see anything from $12,000 to $250,000. The market will correct itself over time, but just here's some free advice. If it's over 100K, it's overvalued. Account opening is something they'll charge you for. That's probably $1 to $3 per account. Keep an eye on that if you plan to get really, really big. ACH and wires cost you about $15 per transaction. That is somewhat standardized, and it's getting cheaper every year, but not cheap enough yet. So I really hope you're not banking small businesses because that'll wipe you out. And then sweet interchange. Like the integration fee, interchange splits haven't really normalized yet. And given how a neobank makes money, that's kind of an important one. Here's a free tip, don't settle for less than 70% of your interchange. Nothing is worth giving up more than that. So I won't list the rest of the things you pay for day by day because we don't have all day here, unfortunately. But bear in mind, your bin comes at a cost, and that cost is daily. Make sure to read the fine print, and the contracts are confusing, so good luck. Okay. One of the things I'd like to note here is that this goes for kind of all the models I'm going to show you. Integration isn't easy, and it isn't simple, and it isn't quick, no matter who you're working with. Yes, it is quicker with a BaaS provider. This is not quick. This is not quick at all. And we're still in the relative infancy of banking as a service, so most banks really aren't set up for that one-stop shop approach. Once you partner with a bank, unless they've literally banked the exact same business as you already, you're still going to have to do quite a significant build into their infrastructure, connecting your cores and then deciding whether you're going to run your own and all sorts of other stuff. It's overcomplicated and it's a pain. So imagine you're going to take a couple of months to get this up and running at a bare minimum, and you're paying for the privilege. So, choose wisely. Okay. This is how things look kind of now when we talk about these BaaS providers. I just realized I should have used Moov. I'm so sorry. That's my bad. Whoops. Okay. So the charter holder is MetaBank here. BaaS provider is Marqeta, and Daylight sits on top to serve their customers. So Daylight is completely freed up to do what they need to do, but they're paying for the privilege. This should be faster. Remember my +3 rule. Essentially, a lot of the obligation gets shifted onto the BaaS provider and the charter holder, but we're going to come back to this in a second. Okay. So some banks have this like awesome little thing where you can basically be a bank and a BaaS provider at the same time, which I think is really neat. So these options are awesome, and they're only going to get better. And I know that shitting on banks is like a fintech pastime. Trust me, I enjoy it as much as the next guy. But banks aren't stupid. BaaS providers, beware. The banks are definitely coming for you, but you got a couple years, you'll be fine. They'll be able to offer the more compelling pricing that we all want. You're not feeding that extra mouth like you are in the last one, and you're not splitting up your interchange so you can actually make some money. Also, this is outdated because I'm pretty sure this card program is defunct, but my bad. Okay. So the last few models I just showed you, but really like the whole segment, was built on this beautiful ideal, democratization of launching financial services products, which was supposed to mean that products could come from anyone, anywhere, and that they would have a safe space to launch and grow. This was supposed to lead to a welcome inevitability. Founders from all walks of life were building products for all walks of life. This lasted 6 months. Now, to use any of the aforementioned models, you need the following: a little more funding than you thought you needed, and a very, very, very clear user base that you need to get to quickly. Otherwise, this is really tough. We're starting to see people put in minimums to work with people like Marqeta. So if you haven't raised, you haven't funded, and you're not sitting on $1 million on top of like your usual runway, there's going to be a problem. That democratization isn't really happening. I mean, I'd love it too, but it's not. So we're going to stop lying to ourselves, I think. Okay, so let's talk about the shortcomings and what we're not getting here, because I think that's the point. So, interchange. The BaaS provider is just another mouth to feed, but that trade-off is really, really, really often worth it. Speed to market is kind of your whole thing, and you kind of really want to avoid any kind of major compliance heartache going forward. Another thing you're not getting here that's more convoluted when you add a player is customer operations. So we all want to talk to our customers, we all want to own that relationship, but we can't really. So managing, so the card that your bank issued for you, your issuing bank, as we remember we talked about, will have a phone number on the back. That phone number doesn't go to you, okay? So you can't really manage that relationship. I'm sure you'll say, that's fine, we'll manage the rest through the app. We can handle some other stuff. They'll just prepare the call center and we'll train them. Great. But actually you're losing more than you think you are. You're only really permitted to answer certain questions by the regulator. So customer ops is really well regulated, it's really well covered. So you'll only be able to answer questions like, how much is in my account? Not like managing disputes. You're not going to be able to do any kind of like cancellation of transactions or whatever else. You're losing quite a lot there, which is the point, right? The point was that you owned your experience, and you don't really. So that was promised to you, and you're not getting it. Okay, this is the big one, and this one hurts. Communication. This is a lot of people to talk to all the time. And I'm not kidding, there's really no good way to communicate yet. KYC regulations require financial institutions to run customer due diligence, enhanced due diligence, OFAC, sanctions, like the whole laundry list of things that are required for customer onboarding. But think about it this way. You've onboarded customers via an app, which is actually managed by a vendor bundled into your BaaS provider's offering, but the buck ultimately stops at the bank. So the bank is going to be held accountable for anything you do and any shortcomings in your process, which is to say, don't you think that the bank should have line of sight to everything you're doing in KYC, and there should be dashboards going back and forth so that they can run the percentage of enhanced due diligence that they're required to run by law? Because I do. So companies like Novello are building dashboards for this exact thing, but if anyone wants to get rich really fast, go build that. It's going to work. So how do we effectively communicate with each other to prevent fraud? We don't. We're doing our best. It's pretty bleak right now. So Another interesting thing that kind of happens with this particular model is that there's like a new graduation ceremony now, but without a hat. So we're at an interesting inflection point in the market. Before, brands would partner directly with banks, as I showed you here. But now with the BaaS players, so many brands signed up to them, but the market is about to move majorly to support brands coming off of the banking as a service providers. So there's going to be a day, probably not in this example because Marquette is huge, but there's going to be a day where Lance will come off Unit because they'll outpace Unit's ability to hold that volume and to manage that volume. This happens about 18 to 24 months within the life cycle of a consumer fintech, and it's super weird. So we don't really have a playbook yet on how that shift goes, but it typically goes from here, 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 just skipping that. So I assume many BaaS customers will end up on the bank that their BaaS was on in the first place. That's probably the easiest move, and you already understand the economics. So this is another weird thing that's going to happen. Again, if anyone wants to build the company to kind of move, kind of move these guys off Marquetta and stuff, you're going to make a lot of money there too. All right, questions? Is there anything? Am I making sense? Don't look at me.
So essentially when you hit scale with this model, you're moving back into model one.
Yes, because you can't really hit scale with this model because the volume can't be handled yet.
Is there a way that you can pick up some of this legal obligation on the institution by like taking servicing rights or things of that nature?
I don't know the answer to that. He wanted to know if there's a way to take legal obligation off of some of these institutions, something about servicing rights.
Yeah, servicing rights. So Upgrade owns the customer relationship and they do the servicing and collections and everything else.
Mm-hmm.
As an example, they are owned and funded by an institution, but they outsource the servicing to a third party.
Right.
And so therefore the collections and elements of that, the communications piece, and then the card example from one.
Yeah.
Like PSC would be a perfect example of a sub-service of credit cards.
Yeah. Okay. Question is like, can you kind of move the servicing piece? A lot of people already do, and some of it's really built into what provider you're working with. That is, a lot of the like communications piece actually happens here, not here. So it kind of skips that first bit. But yeah, you're right. I mean, it's weird. Is there anything else? Yes, Syra.
Between the two models, which one do you think is better unit economics?
She asked between the two models, which one has better unit economics? This one. This is the better one. Because you're owning the relationship and you're not feeding another mouth out of your interchange, you can negotiate a better deal. And a lot of times, since you had to build the infrastructure for your bank yourself to build into, you're building yourself a way forward that's a little bit cheaper. Which means you can definitely negotiate pricing and kind of hold your bank partner at gunpoint, though I don't recommend that. Cool. All right, so I don't remember what slide I'm supposed to be on. There we are. Okay, cool. So here's the major piece we're missing in banking as a service. Can we really say that it exists at all yet? Because I don't think so. I think we're at the beginning of something existing, but we're not close. So this is from the Stripe website. And remember how we talked about the difference between acquiring and issuing and how acquiring's like a lot easier and a lot prettier? Acquiring has this button. Now 3 clicks from this button, you can embed payments into whatever you want to embed payments into. That doesn't exist yet on the issuing side of things. Can we really say then that the Amazon Web Services of financial services exists? Because a lot of people like to say they're that, but it doesn't exist yet. AWS is a ready-to-use infrastructure platform. You go on, you put your credit card info in, and then bang, you're done. You have infrastructure. We don't have that yet. This is still in its infancy, and it's going to grow, but it's going to take a while. What we're aiming for here is this button. We just want the start now to click, plug, play. And I think we're still many, many moons away from that. So today we covered acquiring versus issuing and the much needed cleanup needed on the issuing side. And I showed you a bunch of models that are pretty great, but there's room for improvement, and there's still a lot we can do there. But what can we do? So I don't think you're going to like my answer, but hear me out. Number 1, wait. Providers will become more comprehensive, and things should move faster every year, and that's not so bad, is it? Number 2, skip it entirely. So we can choose to skip BaaS, but you're not going to like how. Reminder that this is what a bank looks like, okay? We can replace all of this with crypto. I'm so sorry. So I'd like to share with you something that my co-founder, Will White, shared with me when I first met him 4 years ago. He was in process of building his third of 4 neobanks, so the man knows his way around it, right? He told me that it used to take an average of approximately 16 vendors to build a neobank from scratch. So now it's a little bit better. It's like 5, but that's only if you're really lucky and you didn't screw up at all. And we're human. We did screw up at all. So let's think about it more as like 7 or 8 vendors to make a neobank. So you can have like 1 to 3 vendors per thing in the stack, right? Like financial crime alone, you can have Hummingbird, Jumio, and Alloy all doing different things to manage your obligation and compliance. And that is great, except that that gets really expensive and really annoying really quickly. So please keep an open mind. ZeroHash is a digital asset settlement and prime services company. They basically embed your own Coinbase. You can run a functioning interchange, or what's that called, exchange in your app, and there you go. That sounds a whole lot like investment banking to me. Conduit wants to give customers access to a DeFi savings rate, so why would you give customers 0.7% when you can give them 5%? That sounds a whole lot like a savings account, doesn't it, Zach? NYDIG wants to give your customers Bitcoin-accessible bank accounts with rewards. So that doesn't just sound like a checking account, that is a checking account. So Paxos and Circle at the bottom here give you stablecoins, which for those of you who don't know, stablecoins are essentially on and off ramps from fiat to crypto, and it's a great way to move money back and forth while not screwing yourself massively. So this is starting to look a whole lot like a bank. The journey here is fiat to stablecoin, stablecoin to crypto, crypto to save, crypto to invest, crypto to fiat to cash out. So the important thing here is that I'm not talking out of my ass. I mean, a little, but not as much as usual. This isn't theory. Go to other markets, Sub-Saharan Africa and Latin America and Asia, all 3, you'll find that this has been in practice for a while now. This is not new, and it's not the thing of tomorrow. It's the thing of yesterday. So you'll see that this is the easiest and fastest and sometimes the cheapest way to build a neobank really, really quick. So if we look at this whole picture, right, this looks really, really eerily similar to a bank. The only missing piece here is regulatory compliance, which admittedly is a big deal. But let me tell you how people are solving that. Uniswap currently has the Web3 version of an RFP out to solve compliance problems. But who's going to solve that for them? Probably not McKinsey. Like, I really don't think that's going to be who goes for that. I'm building a company called Twali that is an infrastructure play to solve these problems. Uniswap can come directly on platform and handpick compliance experts to solve these problems. And in the spirit of Moov, we're looking at ways that the compliance and operations assets developed on platform can be open sourced and collectively owned. We believe this will dramatically reduce the cost to Uniswap, and other builders and contributors can be more widely and equitably rewarded. So sorry to end this on this note, but the future of finance is decentralized, it is distributed, and it is collaborative. Thank you very much. Okay, do you have questions? Did I upset you? I'm sorry. I've done it again.
Does this structure, knowing that this is crypto and not like a licensed regulatory financial institution, do you bypass all the compliance and regulatory bodies that you run into in the traditional model?
Yeah, sure. Okay, so the question was, do you bypass regulation if you go with a crypto bank? I can't say yes because we're being filmed. But sorta for like 5 minutes, and then you go to prison unless you have great lawyers. You will still have to do the hard work on compliance. I'm not gonna ever advertise that you don't do that. But what you will get is that this will get spun up so quickly that it doesn't really matter. You can spend the rest of your time doing the compliance stuff. You'll be fine, I think. Any other questions? Yeah?
What ledger is this set up?
The blockchain. Yeah, that would be the ledger. The question was, what's the ledger? I mean, you would have either a chain you built yourself or something that you bought from someone else, or you would have forked something. Like everyone forks Ethereum, they love that, so that's probably what you would have done. Yeah.
How long do you think it will be before significant enough critical mass of banks have built their own vast platforms that you don't need the intermediary?
Yeah, that's a great question. So the question is, how long do I think it will be before the BaaS intermediary platforms are gone? Ooh, I feel weird answering this here. I think it's soon, but I don't think they're gone. I think they are going to move from doing just fintech onboarding, and they'll start looking at broader segments like playing with Instacart or building for Handy. I think that's where the BaaS platforms are going because they're still offloading that experience. And again, these are huge brands that can offload their upside. I think we're pretty close, but banks are catching up. They have not caught up. And if we put this in bank terms, give it 5 to 10 years. Yeah. Yes. Yeah. Thank you.
Yeah, the analogy that we created sort of happening in places like Kenya or things like that. I think of it in terms of like the same analogy of like Hollow versus Token. And the reason why Hollow works in Kenya is because there isn't a regulatory framework for like how they enter.
Right.
Whereas like there's actually nothing technologically stopping us from being overwhelmed in the United States. The reason we don't is because it's not done.
Right.
So what's the regulatory conversation happening here? Because like my suspicion is it's not regulated at all. One or another, you know which direction it's heading.
Yeah. The question is like, what's the regulatory deal on this, and which way do we think it's heading? At least that's what I heard, Matt. It's close enough. So the deal here is that obviously it's like the Wild West right now, right? Like nobody's really doing anything that useful, but we're starting to see some things that are quite cool. So companies like OpenLaw are building legal contracts wrapped in smart contracts so that everything is happening on-chain legally. They're not using it for this use case yet, but they're probably about to raise a round of funding, and we might see them go that direction. And then there's a bunch of other companies that are kind of working on that compliance as a service piece for fintech generally, and we're going to start seeing it for crypto soon. It is the hardest part, like objectively. And for a while, I'm again so sorry, for a while you're just going to have to use consultants. I feel bad about that, but you are. That's just going to be the game for a little bit. But NYDIG's playing with a bunch of stuff. They have their own like wing dealing with this exact problem when they're building that Bitcoin bank account we talked about. So I don't know, man. It's happening. Yeah.
Just to add to Matt's question or comment.
Please.
Nothing stops regulators to just stop it, right? Particularly, think about politically speaking. We have the ABA, we have all the banking bodies are going to fight this.
Mm-hmm.
And which means that the Senate Banking Committee will get all over this. And from a technology standpoint, I love this idea. From a compliance, risk, regulations, politics, I don't see it happening because there's tons of money in the current infrastructure. And the tons of money that Bank of America will spend on every single bank and credit union gives to politicians. This is just not going to happen.
Okay. I take your point, and thank you for sharing.
I'm not saying that this is not cool and awesome. And
No, it definitely is.
I love it, right?
So-
I agree with you, and I love your outfit, but I don't.
See, this man has understood the assignment, and I wish all of you would do better. So basically the point here is that he believes that this is going to get completely shut down by our various regulators because we have too many in their board. How do you shut down something that does not exist? How do you shut down something that isn't centralized? How do you shut down something that is like spread out all over the world? There are parts of things happening on chain that are happening in like, China, sub-Saharan Africa. They're happening in like Mongolia. How do you get there as the American regulator when you really still haven't figured out an instant payments thing?
China has figured out how to shut some of this down.
Okay, so totalitarianism is the answer. No.
Politics here, and say that we're a truly democratic country. Don't throw things at me. But, you know, there's so much money made in the current system that, that 1% is gonna let us out.
Okay. I just think it's kind of interesting, man, because like we have seen so many cool things happen in community in crypto that just were never possible, even in fintech, and we're a really cool bunch already. We've seen mobility like there has never been before. We're seeing people like get rich overnight on JPEGs, God bless. But we're seeing people do that, and that's. Yeah, I'm shilling, by the way. Please buy my JPEGs. I'm trying to make 100 grand today. Yeah, so we're seeing things that we haven't seen before that you can't actually shut down. Like, how would you even go about shutting down OpenSea? You literally couldn't. I mean, it's just too decentralized at this point. And these companies are gonna build as central entities. Of course, they all are right now, but they're gonna decentralize over time. And you can't shut down what you cannot sue. And that's kind of most of the point there, I think. Yeah.
Kind of more of a continuation of this comment, but I think one thing that builders of things don't really do enough of is actually reach out to policymakers.
Yeah.
And if you could kind of take a little bit of time away from what you're building to go make sure that these policymakers know what we're doing.
And they understand.
Yeah.
I would use Matt for that, by the way.
Yeah.
There's that plug.
I have met with the Senate Banking Committee.
Mhm.
They're clueless.
Yeah.
This stuff is so far out into their future.
How do you shut down what you don't understand?
They barely understand iPhones. And I'm serious. So
Beautiful.
how do we educate them and to show them what the benefits of this are for the underbank, the unbank, for the, you know, all of that is needed, and it's just not happening.
Yeah.
Well,
I think the point there was be an H.M. Bradley customer. Did I just understand that correctly? Listen, I'm just shilling for you. Yeah.
Hi, I had a quick question about this. I apologize for my ignorance because I'm not as familiar with
No.
in terms of the consumer-facing side of this.
Mhm.
So just, quickly looking this up. At the top end, you still have like a Visa credit card.
Right.
Right now, that goes against, that is backed by crypto assets underneath it. We still need all the same infrastructure there. If it could be running these networks, they're going to have, I don't even know if they're going to need an issuing bank underneath that. Because at the end of the day, you've got a Visa card number. Like, how does that work in with this model here?
Yeah, so you actually got ahead of yourself. By the way, the question here was like, how does this work ostensively if you're still issuing cards? So you got ahead of yourself there. We can't do a credit card with crypto assets yet. Like, give it a couple months. I think it's coming. What you can do right now is bank accounts that give you rewards in Bitcoin. I mean, Fold app does that. It's not really a science. It's more of an art. It does the job. You're right. There will be a need for a banking partner. There will be a need for an issuing bank. It just looks a little different and it gets housed differently. So instead of, actually, it doesn't really, because NYDIG will work with Visa or MasterCard, whoever they're on, to issue those cards in the same way that they would have originally. I think this is just the beginning of what I think a banking stack looks like for the crypto bank, as it were. We're probably going to get better at this, and there's going to be a different way to do issuing. I mean, if we look at Lithic, they're already providing us like a drastically different way to issue cards. So it's only a matter of time till Lithic's probably going to do this for crypto. I mean, if I'm giving them free advice, take it. Please do this. I really want it. So yeah, yes, but also no, hopefully. Does that answer your question?
Yeah, I think I understand what you're saying. It's just, my question is at the very top, the consumer.
Yeah.
People are not going to be, signing
Right.
Your average, point of sale terminals doesn't meet credit card rates, so or debit card rates. So how does, like, I just think very interesting how this will eventually connect up in a way that your average consumer is going to be able to.
Yeah, my big guess here is for now, it'll look very much the same on the issuing side. We'll have, like NYDIG will probably work with an issuing bank. That's probably what's going to work for a while they plug into these things on the back end, and these are just embeddable features as opposed to the actual product, as it were. At least that's my guess. I don't really have a good answer, but I like the question and I like where your head's at. Anyone else? Okay, cool. I think I'm good then. Thank you, everyone. This was awesome.